All right, Shane, this one is for you. Risk disclosure statement. Trading security contracts is very risky. You can lose a whole bunch of money. Believe me, I know. I've lost a bunch of money. It is something that can be learned, but there is a 90% failure rate. It's not a plug and play. It's not a gamble. You have to learn what you're doing. You can lose more than you deposited because it's margined. So let's say you put $10,000 in there and then you have $20,000 worth of losses. You got to pay your broker $10,000. So it's a big deal. The way we're doing it, you're not going to risk any money at all. All we're going to do is learn how to trade on a paper money account. Okay. Now this isn't live trading. This is just a concept that I've learned from Michael Huddleston, the Inner Circle Trader. You're wanting to look for a setup called the Silver Bullet, and it's time sensitive. Okay. This is all related to FOMC and the non-farm payroll. The algorithm during this time is not really much in effect, so you can't really count on it as you normally would on a regular day. It's best just not to trade that week unless you just want to gamble, because it'll be a pure gamble. It's best just to sit that week out. So what we're looking for in the Silver Bullet, there's 3 time frames. I have mine set. Let's see. I'm going to set it New York time here. New York. Where are you? There it is, New York. Okay. And also have it set to, I think I've got it set to 8. Yeah, it's still on military time. Let me change that real quick too. I don't want military time. Default precision. I'm just going to do it 12-hour clock. I don't like, oh man, are you serious? It won't let me change it over here. Daggone it. I guess I got to upgrade for that. Okay, we'll just have to do the math. Okay, so London session, New York time is I just love having to scroll through all this. Between 3 and 4. So we'll get us a vertical line here. Line. It's 3 o'clock right there. Okay. We're going to get another vertical line and we'll go to 4 o'clock. That's the first time block we're working with. New York time, 3 to 4. For us, it's 2 to 3 because we're Central time. That's where we would look for it first. The next one is between 10 and 11. O'clock, and then the last time block is going to be between, okay, so we got 12, 1. It's going to be between 2 and 3, New York. 1400, one more at 1500. So these are the candles we're looking at. Right now I have 5-minute candles drawn in there, and that's fine. So we look at each time block for a setup. It's good to have some levels in mind as far as like where liquidity lies. But what you're looking for is what we call a fair value gap that holds up. So from the top of this candle to the bottom of that candle, it creates a fair value gap right there. You just look at that right there, that little section right there. From the the top of this wick to the bottom of that wick, there's a fair value gap. Price went up. It did not trade back down into it. The gap stands. During this consolidation right here, you could go short. I mean, you could go long. So you would buy a long position. It comes down, test it. On this one, it comes down, test it. And then you're supposed to place your stop down here at the bottom of this. That's going to be your barrier. And then this is supposed to be for 5 ticks. So we would be getting in somewhere around 72. So at 77 ish, we would take our profit. So somewhere around there, we'd take our profit. And that's $250. Now that is the London session. So you'd have to be up early in the morning for that. This happens in one of these time frames every day. Every day. But it may not happen in all 3. Sometimes it does. Let's see what it did that morning. This is non-farm day. So we had a fair value gap here. But as you can see, it got traded down into right there. So that, if you would have gone long here, you would have got stopped out. It would have taken out the bottom of that candle. You don't have to put your all the way down at the wick. You can put it right there at the base. You would have got stopped out. You would have lost money. So one of the parameters is that you're gonna be basing it on it taking out liquidity. So liquidity would be up above here, and there needs to be at least 10 handles, 10 points, $10 movement there. So there's another setup right here. Right at the tail end, it looks like it's close to 10 o'clock. Another fair value gap right there. And it got traded down into it. Yeah, it looks like it took it out too. Right there's the top of it. And that body is actually, it didn't take it out. The wick can take it out, but the body can't. So this would be up, a retrace. We're looking to see if it took out this most recent swing high, and it didn't, but it did take out this one on this run up. So this would be a valid entry. Your stop would have to go down below this guy, but I think you'd probably get stopped out there as well. And that's what non-farm does, changes the motion of that deal. So I would leave that one alone, but you can't tell that when the market's moving. And here between the 2 and 3 o'clock, 2 and 3 New York, we don't have any fair value gaps. That one, yeah, I guess you could say that one is very small one right there. These are all on 5-minute candles, so you could try to play that one, but typically what we like to do is see it consolidate afterwards, and then we take a long. That would be okay from 87 up to 52. The market does like to move to round numbers, so that one might have been an okay trade. So that would be our fair value gap right there. We traded down into it with the wicks, but not with the candle body. So that one would actually be a viable trade. You could go long on either of those places, and you would have gotten your proper number of ticks. If you got long even at the top of that candle, that's 92, you could have got your 5 out of it. But ideally, you want to get long when it's wicking down into this fair value gap. So you would get long in one of these. Your stop would go below this candle, and then the trade would work out. So that's that's another example. You can go back through and find this was when Fed Chair Powell was speaking. Bad time to trade. Stay out of it. Let's go back to a normal day. Let's say here's a good day. Go all the way back to London. We'll mark out 3 and 4 London again. Three. And there's 4. Okay. And then we can mark out our 10 and 11. There it is, 10 and 11. And then finally 2 to 3, 1400 and 1500. All right. So we go to London. We see a fair value gap right here, but it doesn't really provide the proper number of ticks. If this is a liquidity pool here, you're already at the top of it, so you wouldn't want to take that one. I would be looking for a downside move just because we've come up off this level several times and reversed. So I would be looking for something going south. So London was not a good play. We go into New York session. We don't have any fair value gaps here. We have a very tiny one right there. Very, very small. 48 to 47, 75, because it does run those types of ticks. So you could say that's one right here. Very, very small one, but it's definitely one. Large red candle, small fair value gap. Not a lot of opportunities to short it there, but on this retrace right here, if you were to go short, you can see it would have gotten you your $250. It just needs to move 5 points. If you went short somewhere in this candle, that's 47. Let's just say 47.50. You would need to get to 42.50 to make your 250 bucks. And it got there on this candle. And then if you were confident in the move and you had a level down here that it might be trading to, like this one, you could leave it in all the way to there. And that's 36. You got short at 47, so we're looking at $500 there. So you could leave it in, move your take profit down here to where it takes these out. That's what the price will usually do, is go down and take out any stop orders that would be down here, and then it'll move back up. So then we look to the 3 to 4 hour. We're looking for a fair value gap. There's one right here, but it's not in our time window. It would have held up. It would have been just fine. I might have gone ahead and taken that one, even though it's a little out of the time window. You can see it. Bottom of that wick to the top of this wick right here on that candle. And everything wicked up into it, but nothing took it out. So it is a valid fair value gap. The candle body stayed below this top right here. This actually the bottom of this candle will be the top of the fair value gap. And you can see that one took it out, but it didn't take out the candle that formed it. So that one would be a valid entry, and you can enter on any of these consolidation candles. Another one would be this one right here. From the bottom of this candle to the top of that one, there's a fair value gap right there. So from the bottom of there to the top of there, fair value gap. These candles went up into it and almost took it out, but never did take it out. If our stop was right up here above this candle, you might even have to put it above the wick, because that one would have wicked you out. But probably wouldn't have entered until I would have entered there, and I probably would have put my stop a little higher, just because it is a tight range. But you could do that. Does it have 10-point potential? You have to look back to see where's our liquidity. I don't know that you would even know that there was liquidity there. So I might not have taken that trade. the 10-point potential, if we got in on that consolidation, we're looking for 5 of 10. So that would be around 51.40. We would need to get 51.35 to get $250. So we would have made it just fine on that candle. And that's the idea of it. You're going through, just looking at charts. You can do this all weekend long. You don't have to worry about the market being open. You just watch. This program does have a replay feature, but you have to pay $15 a month to get it. So I just don't pay for it anymore. I used to, but I don't anymore. I might start. So there's a couple of examples that we did have a little fair value gap that held for at least $250. The other one I'm not going to go into right now. This one's just the Silver Bullet. It's a good system. It really is. It's not based on supply and demand, not based on how many people are buying and selling. It's based on algorithmic movement. The algorithm recalibrates between those hours. That's why those hours are the ones you look at. The setup can happen there and then take the rest of the day to get to a level where you think price is going to go, because the only thing that's making that price move is orders that need to be filled at a recent swing high or a recent swing low. So you can look at that and say, okay, well, price is most likely going to be going up there. So I'll take a long position when I see a fair value gap to the long side and ride that wave, get your 250. If it's further away, get 500, get as much as you can. But take your profit, because it can go away just as quick as it got there. And that's it. I hope that helps. Watching Michael Huddleston's Silver Bullet video, he's more in depth with it. It's an 18-minute video, pretty good.